Today on the Debunking Economics podcast, we know the world is facing a massive pandemic. We've got over 7 million people infected. We're edging towards 500,000 deaths. In the US, 15 more million people are unemployed in the last few months. And the chief scientist at the World Health Organization is saying even with a cure, it could take 5 years to get this thing under control. And yet, despite all of that, we get this.
Pretty good run on Wall Street over the past couple of sessions.
The Dow is up over 400 points, up 438 here. S&P and NASDAQ also firmly in the green.
The S&P is now up for 2020, including a 47.5% gain.
That last voice was Jim Cramer on CNBC, and he's right. The S&P index is actually up this year. So's the NASDAQ. I'm Phil Dobbie, and today on Debunking Economics, Professor Steve Keen and I look at what's really driving this stock market rally. Despite all the tailwinds, has the world gone share crazy? That's today on Debunking Economics. So, Steve, I mean, it's a curious thing. Shares have pretty much continued to rally pretty much throughout all of May and into June, despite what's going on. The NASDAQ, all of them hit an all-time high in early January. The NASDAQ is now hitting a new all-time high, and the Dow and the S&P aren't far behind. And yet we've got 2 million confirmed cases of COVID-19 in America. That's about 1 in 200 people, close to 120,000 dead. And it looks like it's going to be stuck with them for quite some time. And yet people are still investing in shares as though, confidence is at an all-time high. What's going on?
Oh, it's business as usual, frankly, for the stock market. People always, you'll see the market was what the market is always sort of, what's the expression, the anthropomorphism, when the market is given a personality. The market shrugged off disappointing unemployment numbers today. Yeah. Or the market was wary of blah, 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 blah. They're always ex post rationalizations.
It's almost like a god unto itself, isn't it? We all look to the market. Hail the market.
That's right, and the biggest market of all is the stock market. But when you take a good look, and I mean a really good look, at how much does the market reflect the news, the answer is virtually not at all. And there's a wonderful book on the whole structure of the stock market by a guy called J. Peter Edgars. And it's called the fractal markets hypothesis. And that last word, hypothesis. Whoever invented the word hypothesis? Somebody, I think it'll be a lift one.
Obviously, someone who wasn't Spanish.
Yeah. Well, no, it probably was the Spanish king, quite possibly. Anyway, his book argues that the stock market is fundamentally a chaotic system. You have a tiny amount of information coming in from the outside, and then all the volatility driven on the inside of the market. And when he did a look at one part of the book was to take a look at major historical events for the last century. I think the book was written I read it back in about 2000, so around 2000, looking back over the previous century. And when you look at
so the Great Depression, two world wars, sort of stuff.
When you looked at the major events, half the time the market went in the opposite direction to what you might take as the implication of the news for the market itself. The main determinant of the market's volatility is the market itself and not the news coming in from the outside. And
so it's just herd mentality, basically. People following everyone else, seeing it's going up.
It's a mix. It's partly herd mentality. It's a whole mix of things. I mean, one of the things which is the clearest part of what drives the stock market is margin debt. And I think we may have talked about this once before, but I have one of my arguments about what causes asset prices is the change in the new debt that's used to purchase them. And, of course, margin debt's what people buy shares with. And the relationship between change in the new margin debt and change in the stock market is quite strong. So, but what that reflects partly is a combination of things, people's leverage in general, but willingness to speculate as well. You borrow money to buy shares when you believe shares are going to go up. And there's an enormous amount of margin selling, margin buying in the stock market. And my favourite instance of that was looking at the correlation of margin debt as a percentage of GDP to the highs and lows of the stock market. And it was a very long time, it was very low because margin debt was pretty much banned after the Great Depression. But it reached peaks of about 3% of GDP in each of 2000, 2007, and pretty much now. So people are borrowing money to gamble on the market going up. Now, the biggest level of margin debt ever reached was 12% of GDP, and that was pretty much on Black Friday in 1929. And it then fell to 1% of GDP and took the market down with it.
But would you be doing that right now? Would you be building up your debt given the way the world is? I mean, and related to that, doesn't this really show there's, the big discrepancy between the haves and the have-nots? The fact that there are people struggling to survive through all of this, financially, and on the other side, there's people who are saying, "Oh, well, a great opportunity for us to invest in the share market, to have access to the funds to be able to do that."
Yeah,
irrespective of what's going on.
I mean, the usual methodology about the market reflecting what's happening is basically saying news is coming in from the outside, and the market interprets that and puts it into the valuation of assets, which is seen as a sensible and indeed necessary part of a well-functioning capitalist economy. But one of the economists who knew the most about the stock market and how ridiculous it was one John Maynard Keynes, because he actually got involved in some speculation, partly on his own benefit and partly for King's College in Cambridge. And in one of his many wonderful anecdotes, he described himself as a speculator who'd lost 2 fortunes and made 3. And he was successful in the final stages of his dabbling in the market because he simply gave up on the idea that the market was reflecting the news. And he made this wonderful analogy of the market to the game of musical chairs, where, you've got to be running when the music is playing. You want to sit down when it stops. And there's basically an internal panic at all times to be the first in and the first out. But he made the analogy to what a beauty contest, where he said the object we have a newspaper contest. This is back in the old days of happily sexist newspapers, of course, where you have a prize which is awarded to the person who guesses the 6 most attractive faces out of an assembly of 100 faces. And he said the winner is not the person who picks the 6 objectively most beautiful people, nor is it the person who picks the average guess of what the 6 most attractive people are. He said the victor is the person who guesses what the average person will think the average person thinks is the most attractive person. And he called it the madness of the third degree. And that pretty much applies to the stock market.
Yeah, I mean, and I have spoken to so many people who invest in the share market and say, what's going on? And first of all, people go, oh, well, and they make excuses, it seems, like, they're seeing through the current situation because it's forward looking. They're looking at what happens next. That's one excuse. And the other one is, I don't know, it's crazy, but I'm just going to go with the flow because everybody else is. And then you look for the technical signs that it's about to turn, as you were indicating, that the moment it starts to turn, then everyone tries to bail out. So the idea that because I have this old-fashioned idea that maybe shares are somehow related to the intrinsic value of the companies that they relate to. How foolish am I for that kind of thinking?
Well, you're foolish enough to get a PhD in economics. Congratulations. Would you like me to send it by mail order or by ship? Because
I don't care if it gets lost on the way, by the way, so however you want to send it.
Okay, I'll send it by Turkey in that case. It'll get faster by Turkey than any other means of transportation right now. Particularly the Turkey says, I have COVID.
You're speaking again.
It is mainstream economic theory came out with the argument that the stock market is a risky asset where the value of the market reflects the value the shares get on the market reflects people's expectations of its returns over time and the volatility of those returns. So the efficient markets hypothesis, another time, was this argument that you have a choice of investing in a riskless asset, which they took as long-term government bonds, where there's a guaranteed rate of return but no volatility in the asset, or risky assets, which are basically shares, which will give you a higher return but come with a higher volatility. And the argument was that, what you actually put the valuation of a share reflects the net present value of the rationally expected income stream of the investments over time. Now, that was an incredibly popular argument with economists because it basically it justified the market, said the market is efficient. That's where the term the efficient market hypothesis came from. And it's been roundly rejected by the data, absolutely thrown out of court by the data. But, hey, let's continue believing it because it's an essential part of how we think markets actually operate.
So, if it is not efficiently pricing the value of companies and it is really just a scheme that is perpetuating wealth for those people with wealth, adding money to those with money, is there another approach that's needed? Do we do away with the share market altogether? Well, that is the next question I put to Steve Keen in the full version of this podcast. To hear that, you need to subscribe at debunkingeconomics.com or go to patreon.com/Prof Steve Keen. You can hear the full episode of this and all the other episodes in this series as well. I'm Phil Dobbie. He's Steve Keen. See you again soon. Thanks for listening.